a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about MegaCap technology stocks and whether their rally can continue in the second half of this year. So let me share my screen. So if we look at the first half, 60% of the gains were driven just by 5 MegaCap companies, which is NVIDIA, Microsoft, Amazon, Meta Platforms, and Apple. And that is according to Financial Times data. And NVIDIA alone accounted for almost a third of the market gains. The rally became even narrower in the second quarter. And in fact, 90% of the second quarter market gains were driven by just 3 mega cap companies, NVIDIA, Apple, and Microsoft. And we have seen that last week when NVIDIA took a slight break, well-deserved break, then other technology giants like Tesla, like Amazon, they started outperforming. But overall, these companies continue to do so well. And we know that we are currently in a higher for longer interest rate environment, and that is generally good for big tech companies because these are high quality, cash rich companies. So, biggest question for investors is whether this rally can continue in the second half. And you must have seen many comparisons with the dot-com boom. Now, the big difference is that the dot-com boom was fueled by speculative investments in unprofitable companies. And on the other hand, this AI race is funded by deep-pocketed tech giants. And I also believe that AI boom is in early stages. AI presents groundbreaking opportunities to significantly boost productivity across many sectors. So companies across many sectors tend to gain. And we know that generally, historically, a strong first half bodes well for the market for the second half, but we don't need to pay a lot of attention to historical trends. Let's look at the other reasons. We know that trillions of dollars remain parked in money market funds and other cash equivalents. And if even a small part of this gets deployed in stocks, that will boost the rally further. And when investors chase this rally, they will obviously put their money in areas which have been working so far. Even active managers that have underperformed the market, if they did not have a lot of exposure to these mega cap technology giants, or if they had a lot of exposure to cash, when they will chase this rally later this year, they will probably put their money in areas which have been working. And again, when we see comparisons from the dot-com boom, we see that valuations, they do not look insane. In fact, the Magnificent Seven valuations, they look slightly stretched, but they remain below their pandemic peak and also pre-rate hike levels. That is according to State Street research, because the rally is driven mainly by strong growth rather than multiple expansion. And looking on NVIDIA in particular, which is the poster child for this rally. So NVIDIA is currently trading at around 46 times forward earnings. And at the height of the dot-com boom, Cisco's share, which was the poster child for dot-com boom then, Cisco shares were trading at about 130 times forward earnings. And earnings outlook continues to improve. These companies offer very high quality growth exposure. And according to Zacks earnings trends, Magnificent Seven stocks, their Q2 earnings are expected to be up more than 25% in the second quarter. Now let's take a look at 3 ETFs. So I have talked about these ETFs in the past too, so I will not be spending a lot of time. So the first one I'm highlighting is by Invesco, the cheaper version of the NASDAQ 100 QQQ ETF, ultra popular QQQ ETF. This is cheaper with a 15 basis point expense ratio and continues to gather assets. It's now gathered about 30 billion in assets, and I own it in the ETF investor portfolio that I manage. So if you want to learn more about this ETF, let's go to the quote page on Zacks.com. You can read our research report, articles, go to Invesco webpage. So these Magnificent Seven and some other stocks like Broadcom, which have done quite well, they account for more than 50% of the portfolio. The second ETF that I'm highlighting is another ultra cheap way of getting exposure to mega cap technology and other growth stocks. 22 billion in assets. The ticker symbol is MGK by Vanguard and charges just 7 basis points expense ratio. So again, to learn more about what it holds, you can go to the quote page on Zacks.com, and from there you can use the link to get to Vanguard's web page. So again, dominated by Microsoft, Apple, Nvidia, Amazon, and other high growth stocks, which account for more than 50% of the portfolio. The third ETF that I'm highlighting is for investors who want exposure to just the Magnificent Seven stocks. So this ETF by Roundhill, this provides equal weighted exposure to Mag 7, to slightly pricey, 29 basis points because of this specialized exposure. And it has been quite successful, 632 million in assets. So it launched last year. And again, let's go to the quote page on Zacks.com. And this is the web page for this ETF. You can read Roundhill's research, and you will see that Tesla, because of the recent rally, this is at the top currently, but just Mag 7 stocks. And at the time of rebalancing, all these will be brought to equal weights. On the last slide, I have the performance compared to the S&P 500 index. So because of NVIDIA, the Mag 7 ETF is up more than 60% over the past year. The Invesco ETF is up about 36%, and the Vanguard product is up about 40%, whereas the S&P 500 index is up about 28% over this period. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to our YouTube video channel so that you do not miss anything. And I'll see you next week.